Meta is a stock that's been on a bit of a roller coaster over the last 5 years, and that might be a little bit of an understatement. We can see over the last 5 years just 180% from where it was, which is good. You're outperforming the market, which is up about 90%. That's what the S&P 500 has done. But you hit highs in 2021 about 360, that's 380, that's pretty good. You hit as low as 90, in the 90s, closed 90.79. And then you ran all the way up to 615. So Meta, although overall it's performed well, it's had an absolute low, just a crater, and then just an insane run up from there. One of the biggest run ups out of almost any company you can find from that period, like large company. Nvidia maybe has done a bit better up. I don't know off the top of my head, but Meta is a company that's done very, very well. It has, even though a lot of people left it for dead. Its PE was in the low 10s. And you can see over a decade or so, it's performed pretty well, up from about 75-ish. So this is a company that's done well. However, we're going to be looking at the future of this company in this video. We're going to be looking at earnings, profit margin, debt, things like that. We're going to just dive into this company and see, hey, how does this company look going forward? Is this a buy? Is this expensive right now? How does the PE ratio factor in that? We're going to be looking at all this in this video. Of course, when investing in a company, it's really important to understand what they do. Normally, I spend quite a large segment of this video trying to explain what some companies do. Meta, it's really pretty simple. I assume most of you have heard of Meta, 99% of you watching this video. They are the parent company of Facebook and Instagram. I assume all of you know what those are. Social media platforms, and all their profit basically comes in through advertising. You log on Facebook, they give you a personalized ad because they harvest your data, or all the companies do, and they sell it to each other. That's beside the point. That's a little, but hey, they make money from it. So that's what Meta does. Advertising, advertising, advertising. They're pouring money into AI. Specifically, they've been pouring money into the metaverse, which is a virtual reality universe. And it's been generating a little bit of revenue, but really nothing crazy. So all their money comes in through advertising at this point. It's really pretty simple. And we're going to dive into that a little bit in later this video with the revenue breakdown and similar stuff. Their current PE is 28, which is pretty good. Like, that's below the S&P 500, which is at 30. That's cheap. However, their forward PE is 27, which isn't bad. But the S&P 500 is 23-ish right now. So if everyone hits their metrics, it's not cheaper than the S&P 500, so it's not really fair to say that. However, this is still a company compared to how it's grown over the last 5-10 years. You would expect it to be higher, and you can see that reflected in a lot of the other Mag 7s. PE's valuations. The only one kind of around it is Google as well. They're kind of in this range. But you look at Apple, you look at Tesla, you look at Nvidia, you look at all these other companies, and they have much higher PE valuations than Meta, at least at the current moment. So you would expect it to probably be a bit higher in this market. So you could see a little bit of run in the short term. I don't expect that. And I don't expect Mag 7 companies to have PE in the 30s like forever. I'm not saying that. However, just when you look at the current environment, it is relatively cheap. And we can see the earnings per share is a bit of a roller coaster, and that's not really an exaggeration at all. Most of you remember, not all of you, but most of you remember back in 2022, this went from middle 2021, 370 to late 2022. It was in the 90s. It was in the 90s. Just crazy, crazy fall off. Everyone was down on them. They were losing money. They were pouring money into the metaverse. Everyone was making fun of them. Oh, this isn't going to do anything. And to be fair, metaverse hasn't done phenomenal, but it's still generating some revenue. It is, and it's worth something. It's not like a crazy amount, and everything else has been doing great as well. You lost You're down 37% on earnings per share, which revenue was basically flat. So, of course, you want revenue growing, but you weren't actually really losing that much. And then, look, 73% growth. Crazy. Of course, you went down 37, then grew 73. So maybe it's like, okay, that's average. But then this next year, you're projected to grow 52%. That is crazy. Then you can see with revenue, okay, so flat 1 year and then 15. So evens out to 7, something like that. And then you get 21% this next year. That is great. That is phenomenal. And you don't have to get these crazy increases in earnings per share year after year if you can just grow like anywhere near this range, even something like 13, right? You would expect the S&P 500 performs like 10, 11%. 13 is even better. It's a higher profit margin business. You would expect margins to stay elevated, maybe even grow a little bit if they can be more efficient. But still, if you can grow anywhere near 21%, I mean, compound 20% for a couple years, 4 to 5 years, and see where you're sitting. It's kind of crazy. So that's a reason growth stocks have high PE, and that's also a reason why I'm really not scared at all in the 20s with a company like this, a company that's grown like this, company that's been growing like this. It's really probably, in this market, it's probably pretty cheap. It really is. Now, in the grand scheme of things, is it cheap? No, but this is probably where you would expect it to be. And when the PE of the S&P 500 contracts, you're probably going to be sitting above it in the long term if Meta continues doing things like this. So I think we're going to look a little bit back when we go into the income sheet and things like that, but this is a company that is growing and is growing pretty fast. On the balance sheet, the first thing I always like to look at is debt, because it tells you a lot about the company, the strategies, the planning, or is it risky? Are they crazy amounts of debt? Looking at Meta in 2019 through 2021, they had like nothing. Like, this is, for how much they bring in, they had no debt. I mean, they had debt, but like in terms of anything that's practical, they had no debt. And then 2022, they started borrowing, and they doubled that in 2023. Doesn't really concern me. I looked it up. Maybe they're borrowing before rates. They borrowed in late 2022 after rates already started to rise, and of course, they borrowed more in 2023. So you would have ideally been able to have the forethought for Meta to start borrowing a little bit earlier, although it doesn't really matter too much. Shows you the company's ambitious, and a lot of this money was poured into AI and stuff like that, so it's really not a big deal in the long run. It really isn't, but it's still, you would have hopefully been like borrowing in a better rate environment. But like I said, it doesn't really matter too much in the long run, I don't think. And it's not a large percentage compared to how much they bring in, right? I mean, income this year was $46 billion. So $19 billion total debt, not an issue, nothing risky at all. Looking at some other things, total current assets increasing, total assets increasing, liabilities increasing, but not dramatically, and not a large percentage to what we are bringing in revenue or profit at all, so it's not concerning. Nothing really concerning there at all, or super optimistic either. Taking a look at revenue, you did $70.5 billion 2019, now you're doing $134 billion, so just under doubling. Same thing for operating income. 2019, you're doing 24, or just income in general, right? And then you're doing 40s. I mean, that's what it is, but don't worry about it. It's 24 billion, and now you're at just under 48 billion, so just under doubling. That is very good. However, remember, this is 2023. We're basically through 2024. We don't have the last quarter, but unless you miss dramatically, which very unlikely. But even then, you're going to do 156 billion basically. So you're going from 70 and a half to 156 in 6 years. That is a very, very good performance. It really is. And your profit's probably going to be right around that as well. So that's good. That's very good. I mean, just do it in your head, or take out a calculator. Double every 5 years, do that for 5, 10, 15, 20 years. See where you're at. Very, very good performance. Clearly outperforming the S&P 500 and the average company with this. And they're investing into what I see here. And you see this in some companies over long term. You see this in Microsoft. I just did a video on that. Their income increased more than their revenue did. But with Meta, you don't really see that. It's basically the same. You just under doubled both. Obviously, you could be off a little bit, but basically, your profit margin maintained the same. I think over the long term, I think Meta is going to be able to increase their profit margin. I think so. I think investment into AI and things like that, and just other industries over the long term, they're going to be able to increase their profit margin, even just a couple percent. But if you get that revenue growth that we expect them to be able to do, and we've seen them be able to do, and then you increase the profit margin even a couple percentage points over the long term, that's going to make a substantial difference, over a 5-10 year period. So I am pretty optimistic about this. It looks good, right? You want to see the growth that they've been having. Of course, like I said, 2022 is a little iffy, but it doesn't really matter as long as going forward we're good. So I'm optimistic about looking at that. And like I said, if a couple of things can keep going right and they can increase profit margin a little bit, they can do well on AI. This is a company that looks like they're in a very good spot. Taking a look at the breakdown of Meta's last quarter is actually pretty simple to break it down, right? Almost all their money comes in through advertising, just under $40 billion. That is a lot. We can see 19% year over year, but we know this is growing. We know the projections. They're doing well. A couple things that stick out to me. One, 15.7 billion in profit. That is pretty good. It really is pretty good. It's not like crazy blow your mind, but it's pretty good. But I do think this can grow. And I do for a couple reasons. We haven't seen over the last 5 years a whole lot of growth in their profit margin, and a lot of companies that have been investing in cloud AI, things like that, have seen an increase in that. But like I said, it's still pretty solid. But another reason I think it's going to grow, if we look at R&D here, it's pretty high. It really is. It's not unfathomably high. It's not the highest I've ever seen. But for a company, look at some companies that are kind of in the space. Look at like Google's, look at Apple's, look at Tesla's. I know Tesla is very different, but like look at large tech companies and what R&D makes up as a percentage of their revenue. I mean, they're almost 25%. I just looked at a few just to like confirm that I'm not just like losing my mind, but most of them it's nowhere near. The only one I found, I looked at like 5 or 6. AMD, which of course not super similar, but if we're looking at mega cap tech companies, that's kind of, we don't want to look at something like a manufacturing company, of course. And theirs was like for 6 billion in revenue. I think it was Q2 2024. They had like 1.5 billion in R&D, which still isn't quite. It's pretty close, but it's not quite where Meta is at. So this is a lot in R&D, and over time, right? We're looking at debt. They're bringing in debt as well. I would expect the money they're pouring into AI and the metaverse and stuff, this R&D eventually as a percentage of revenue, as like a cost, over like a 3 to 4 to 5 year period is probably going to slow down. In the short term, I don't necessarily mind them putting more in R&D, right? If you're an investor, assuming that pays off. Assuming you have an increase in revenue because of that, assuming it's money being put to good use, I have no issue with that. I really don't. So there's nothing else here that really sticks out too much. High gross profit compared to just cost of revenue is pretty low as well. But like I said, I think this can increase at least marginally over the long term. And as long as we can keep seeing growth there, and hopefully their AI ventures and that sort of stuff really picks up and does well. But it's really pretty simple. Advertising money comes in, profit comes out, and you have a very healthy cash flow, a very healthy profit margin in here. Like I said, I think it can increase marginally. I really like to look at historical PE for companies because it gives you a really good context of the company and a good understanding of where they're at. And I think there's also an important lesson here, and I've talked about it on this channel before, but it's hard to understand sometimes. And there's two ways. Don't get me wrong, PE is super important. I look at PE for every stock. I factor it in. It's one of my main important factors when looking at a company. However, this is very important. There is times when PE is not perfect and it's wrong and it's lying to you. And this is one of those examples specifically. There's two that'll get you. The one is not occurring here. It's where you're either like pouring a crap ton of money into investments, so your profit margin is significantly lower because R&D costs, right? If we bought, a bunch of new stuff, spent all our money, we may be lost money this quarter, but outside of that, or you're writing off some debt that you merge with the company. Another one is when you're just becoming profitable. It can really throw you off because we can see the PE ratio for Meta here. It was like from early 2013 or late 2013 to early 2016, you were in the 60s, right? Near 90, 70, 70, 70, 87. I meant 60s is like the lowest it was. But because you just became profitable and because it was so easy to increase that earnings per share, we can see if we go from late 2015, we were at 90, 80, we're at $1 EPS, and then later that year, or late 2016, 2017, we were at $3.50. Did Meta start making 3.5 times more or 2.5 times more money? 3.5 times more money? Not really. That's not what happened. They just became marginally more profitable because their revenue was so huge that it really wasn't that much doing it. So if your company is something like a SoFi, something like, and I don't know, there's plenty of examples. Companies just becoming profitable. Or something like Pfizer. Pfizer was unprofitable for a couple quarters. They're going to become profitable again. Their PE, they didn't have a PE ratio, but now it's going to be like 12 or 16, something like that. Last I looked at it. So that's throwing it off. But anyways, that's just a quick lesson there. If we're looking at the PE ratio of this stock, historically, let's just say from 2017, kind of when it hit normal ratios, it's bounced between high 30, in 2022 when we're getting crushed. Remember that we were in the 12s, right? And it was actually a bit lower, but that was kind of where it was hovering at, 12, 13. But it was expected, and it was it was like an expected company that, hey, this isn't going to grow. That's where it was being valued at this time. They were looking at, hey, we went from 14 earnings per share to 8. What the hell is happening? And that's understandable as an investor. That is scary. And no one really, it's an anomaly with Meta because I've talked about it before, but it really went down crazy fast and rebounded crazy fast. But that's going to happen sometimes. But historically with this, if we're looking at historical PE, somewhere between, let's say, low 20s, high 30s. Okay, right? Remember what we're looking at with here, guys. We're looking at mid to high 20s right now. So you're right in the middle of that range. You really are. If we're talking like 22 to 36, we're at 28. That's right in the middle of that range. So as a long-term, if we're looking at long-term history, if this grows like it has historically, if it's valued like it has been historically, this is a company that's valued right in the middle of that range where you would expect it to be. So in terms of, okay, is this a good buy? Well, if you're interested in it, this isn't a bad buy. It's not. So, of course, I'm not going to tell you what to do. And I don't necessarily think it's screaming super cheap either. But this is probably right in the middle of that range where you'd expect it to be valued. Of course, every company has its own unique risks and advantages, and I don't have time to cover every single risk in this video, so I'm just going to cover some of the main ones. Specifically, if you have any concerns or risks I don't cover in this video, you can ask them in the comment section, and I would like to address them at least in a little bit of detail. But specifically with, of course, their money comes in through advertising on social media platforms. There is a history of social media companies and social media platforms falling out of favor. Tumblr is a good example of one recently that was worth, I think, bought for almost $10 billion and then like worth almost nothing now. I think it's basically defunct. So I'm just spitballing that. I'm not 100% certain on that. And then you see old, like the old ones like a MySpace right now isn't, of course, it's basically dead as well. It is dead. So something like a Facebook, though. I know there's not a whole bunch of young people using it constantly, but there's a lot of people still using it, and it's still important to be plugged into it. Like, I'm not a huge social media guy, just to be honest, guys. I'm not. I don't use it a whole lot. However, specifically with a group I was a part of in college, I basically had to make one and use it, at least decently. So even if it was just mainly for the messenger. So having so many people plugged into it makes it more and more important for people to get on that. And like I said, they have Instagram as well, and they're investing money into the metaverse, investing money into AI specifically. So it's not, I think it's, I hate the term too big to fail, but it's safe. When you have a company bringing in, $14 billion in profit every quarter, and they're diversifying into other avenues, it's really not something I'm like super concerned about. There's some other things like regulatory concerns with data mining and like data harvesting. Of course, they're taking data from you and trying to sell the right stuff to advertisers, try to pin the right advertisers on you. And there's regulation concerns, but when you look at all the top tech stocks, there's some regulation concerns. I guess competition as well. I think part of the reason in 2022, I think Apple changed how you are allowed to get the data from them, and that really messed up Meta specifically on their app. So, but they're going to adjust, and they have adjusted, and we can see with the profit now, it's really not too much of an issue. So I don't see, and so advantages, right? There's social media software. Those generally have higher profit margins. We can see some of that. I know, like I said, they're diversifying into some other fields, AI and things like that. But generally, they're going to have a pretty high profit margin, and there's just a lot of money flowing in, and there's not a whole lot they have to do day to day to day. Advertising is pretty safe. There's always going to be advertisers. That's never going away. And that's just a market that's lucrative and just keeps on compounding, actually. So there's not a whole lot of crazy, I mean, of course, normal risks if the company starts doing poorly. And we've seen it recently fall down quite a bit, but they seem to be at least willing to put their money where it is. I guess if their ventures and the money they borrow, right, the money they borrow and are trying to pour into AI and their recent ventures, the money they're pouring into R&D, if that doesn't pay off, yes, that's a risk, but every company does that sort of stuff. So it's a risk unique to the company because they have it, but every company has that sort of risk. I guess it's because they're putting more money than the average company, at least right now. But yeah, they have strong advantages. They have, literally billions of people plugged into Facebook. Instagram is wildly popular as well. They're pretty safe with what they bring in. I don't see that falling anytime soon. So they're in a pretty good spot, and Schwab agrees with that. So usually I don't cover that too much in these videos. I don't really care what other people have to say too much about companies unless everyone's saying it's horrible. But even then, sometimes, like I like AMD right now and they disagree, but hey, top 6 percentile, that's pretty cool. I'm not the biggest stock projection guy. I think oftentimes there's too many variables and factors that come into a stock's valuation in the short term to say, okay, in a year it's going to be here. Because there's so many caveats. What if there's a recession? What if there's something unexpected in the broader market? It's just so hard to do that. However, it's important in these videos, in my opinion, to say where I think the stock is, where it's going to be in the future. We can see the performance. Let's just look at that again real quick. 182%, doubling the S&P 500. If we zoom out, if we go to early 2015, which is about a decade ago, usually somewhere, I like to look at 5 and 10 years. Of course, sometimes there's things that happen right up or right after that factor into it, but 2015, it was at 80. This is a company that's outperformed the S&P 500, outperformed it pretty substantially, and I probably expect that to continue going forward. I expect this to be a company, the money they're pouring into AI, I expect them, hopefully, to hit on that. Not a home run, not a grand slam. I don't expect this to be one of the best companies in the world. Low expectations, right? Or reasonable expectations. But I think Meta is going to be a company that outperforms the market in a 5 to 10 year period, or let's say 5 to 7, assuming no recession. But even then, holding off recession, let's just say normal PE levels, things like that. This should be hopefully a company that is outperforming the S&P 500. It has historically one of the larger companies in the world. They are in a great position. It would be pretty disappointing if they did not outperform the S&P 500, at least substantially. I'm expecting it to, let's say, 25 to 50% outperformance, which is very good. That is very good. If it does better than that, awesome. That's where I would probably expect this company to be. I would not have an issue of putting my money in this stock at all. I think they're in a good spot. Even with the run-up, I don't think it's anything crazy high. And I think this is a company that's going to continue to do well into the future. But anyways, that's all I have for this video, guys. If you enjoyed, I appreciate if you like and subscribe. I do daily stock content on this channel. I assume most of you watching enjoyed at least a little bit. So if you want to catch stuff, hit that subscribe button. Helps YouTube recommend it to you again. But anyways, I just appreciate all of you for watching, and I'll catch you next time.